Gross domestic product is arguably more useful when comparing living standards between nations, while nominal GDP is more useful comparing national economies on the international market. The Organization for Economic Cooperation and Development, total GDP can also be broken down into the contribution of each industry or sector of the economy. The ratio of GDP to the total population of the region is the per capita GDP, and the same is called mean standard of living. GDP is often used as a metric for international comparisons as well as a broad measure of economic progress. It is often considered to be the world's most powerful statistical indicator of national development and progress. William Petty came up with a basic concept of GDP to attack landlords against unfair taxation. During warfare between the Dutch and the English between 1654 and 1676, Charles Davenant developed the method further in 1695. The modern concept of GDP was first developed by Simon Kuznets for a U.S. Congress report in 1934. In this report, Kuznets warned against its use as a measure of welfare. The switch from GNP to GDP in the U.S. was in 1991, trailing behind most other nations. The role that measurements of GDP played in World War II was crucial to the subsequent political acceptance of GDP values as indicators of national development and progress. A crucial role was played here by the U.S. Department of Commerce under Milton Gilbert, where ideas from Kuznets were embedded into institutions. The history of the concept of GDP should be distinguished from the history of changes in ways of estimating it. The value added by firms is relatively easy to calculate from their accounts. But the value added by the public sector, by financial industries, and by intangible asset creation is more complex. These activities are increasingly important in developed economies, and the international conventions governing their estimation and their inclusion or exclusion in GDP regularly change in an attempt to keep up with industrial advances. In the words of one academic economist, the actual number for GDP is, therefore, the product of a vast patchwork of statistics and a complicated set of processes carried out on the raw data to fit them to the conceptual framework. GDP became truly global in 1993 when China officially adopted it as its indicator of economic performance. Previously, China had relied on a Marxist-inspired national accounting system. GDP can be determined in three ways, all of which should, theoretically, give the same result. They are the production approach, the income approach, or the speculated expenditure approach. The most direct of the three is the production approach, which sums the outputs of every class of enterprise to arrive at the total. The expenditure approach works on the principle that all of the product must be bought by somebody. Therefore, the value of the total product must be equal to people's total expenditures in buying things. The income approach works on the principle that the incomes of the productive factors must be equal to the value of their product, and determines GDP by finding the sum of all producers' incomes. Also known as the value-added approach. It calculates how much value is contributed at each stage of production. This approach mirrors the OECD definition given above. Gross value added equals gross value of output, value of intermediate consumption. Value of output equals value of the total sales of goods and services plus value of changes in the inventory. The sum of the gross value added in the various economic activities is known as GDP at factor cost. GDP at factor cost plus indirect taxes less subsidies on products equals GDP at producer price. For measuring output of domestic product, economic activities are classified into various sectors. After classifying economic activities, the output of each sector is calculated by any of the following two methods. The value of output of all sectors is then added to get the gross value of output at factor cost. Subtracting each sector's intermediate consumption from gross output value gives the GWA at producer prices. The second way of estimating GDP is to use the sum of primary incomes distributed by resident producer units. If GDP is calculated this way, it is sometimes called gross domestic income, or GDP. GDI should provide the same amount as the expenditure method described later. By definition, GDI is equal to GDP. In practice, however, measurement errors will make the two figures slightly off when reported by national statistical agencies. This method measures GDP by adding incomes that firms pay households for factors of production they hire, wages for labor, interest for capital, rent for land and profits for entrepreneurship. The U.S. National Income and Expenditure Accounts divide incomes into 5 categories. These 5 income components sum to net domestic income at factor cost. 2 adjustments must be made to get GDP. Total income can